So there's been a lot of volatility in the last few days. There's been a lot of central bank action, discussion. There's also been a lot of government intervention with regard to M&A. So let's tick these things off one at a time, I guess in the order in which they happened. So you had a very dovish statement out of the ECB. Draghi is, doing his thing. That was on 310. So that was an opportunity for the bears to really kind of sink their teeth in, I would think. That we were right at a downtrend line. You had had a lot of move up. You were right to the 61.8 Fibonacci retracement in the SPY. And on the heels of that, you got some dovish comments out of the Fed. So Yellen basically did a bit of a capitulation, her sort of I'm sorry moment. She basically ticked off everything that I had been looking for the Fed to say, other than her openly saying we messed up. I could use some more colorful words, that some of those four-letter words to describe what they did, but they definitely made some very large, yes, they messed up. Big time. They hiked interest rates right into a global growth slowdown. That was confirmed today, by the way, by Lagarde. I always joke around with Yellen. I always say that her and Lagarde are BFF. And Christine Lagarde basically came out today and warned about slowing global growth. That is a very big concern. The Fed was discussing that as well. They've discussed a few things. I just have my Fed notes here. I don't really want to go into them too much, but one of the things that struck me, and I'm just going to do the very summary of the summaries here, is they are perplexed that they cannot, no matter how much money they throw at the situation, generate inflation. The only inflation, I guess, or where people are really spending their money is healthcare costs have been skyrocketing, which is supposed to be the exact opposite. And I guess costs of living, housing has been a little bit more on the uptick. But that's always a consequence of low interest rates. So they had discussed that the lower rates, of course, they say support spending. Bullard was out saying that low oil prices are good for the economy. This is all very true. The issue, though, is that they said that the risk here is downward revisions for their inflation expectations, meaning they are not only, we're talking about stall speed growth, but there's no inflation, so there really shouldn't be any reason for interest rate hikes. Fast forward to the Fed funds futures, and we are now not pricing in the possibility of another interest rate hike over the probability of 50% until December, which is good. You have now seen a rally in treasuries and a bit of support in treasuries as a result. If they're not going to raise rates, there's no reason to panic out of your bonds, your utilities, your municipal bonds. All of these asset classes are long and strong, I would say. So here's the question, and this is what Wall Street kicks around every day. Are stocks cheap or are they expensive? Now, you can make the argument, I would say, either way, depending on where which side of the coin. I guess it's sort of both the same side of the same coin, what I'm about to tell you. But for some reason, people only seem to understand one side of these coins. One is, yes, earning, we have no growth. We're at a premium PE multiple, and the market is expensive. Yes, that is correct. Number two, the market deserves to trade at a premium multiple because interest rates are historically low. They always forget to mention that key component. The bond, competition, or the ability to put your money into other things, as well as companies' own ability to invest in projects that they might not normally be able to because of the higher cost of capital, all become very possible. So the market, obviously, we know. First of all, we know interest rates are at a historical low, and they've been low for a while. That's forced a lot of people into stocks that normally might not be because they can't get money in their money market accounts. Try going to the bank and getting any interest, or CDs or whatever, they're just not there. So they've been bidding up the bond equivalents. That's how you get companies like Coca-Cola, which is, I guess, the closest thing I could think of to a bond equivalent, that like Johnson & Johnson, trading 27 times earnings with, stagnant growth just to get a 3% dividend. So that is the case here for higher PE multiples. People need to put their money somewhere. Yes, it's very expensive. That is crazy expensive for Coke. You don't hear me pounding the table saying that it's cheap. Although, believe it or not, I think Coke could even get a little more expensive. I actually believe it wants to see $50. Johnson & Johnson trading at 19 times earnings with a 2.75% yield. Contrast that to Google, which has tons and tons of growth. It's trading 33 times earnings, only 10 multiple points premium over Coke. And Google is a double-digit grower. If you factor in Google's growth, you're probably talking with a multiple in the 20s. So Google is technically cheaper than Coke, as crazy as that sounds, just because it pays a dividend. I absolutely, at this price, would prefer Google over Coke any day of the week. The only problem for Google, and I'll tell you this, is that right or wrong, and I was a double major in college. I was, I guess, an overachiever in that sense. I studied both finance and marketing, and I can tell you when the economy gets squeamish, the first thing companies cut is advertising budgets, and that would, of course, impact Google. So that probably is one of the reasons why people are a little squeamish about Google. But yes, it does make sense. The only thing there is that people are ignoring a secular change from moving from print to online. So while the overall market might contract in that sense, the share that Google would get overall would probably be higher, and that trend is probably never, ever reversing, because once you go online, once you go tech, you never go back. Anyway, that's the battle that's been playing out here. The battle between the bulls and the bears, whether the market here is expensive or if it's cheap, based on PE multiples, and based on that context in the low interest rate environment. So I could make the argument, and I have in the past, that the market can stay stubbornly high longer than people think, as long as the Fed is keeping interest rates low like they are, which we know they are, because Yellen came out. You know, a lot of people the other day were very quick to poo-poo Yellen's statement and say, oh, it's just more Fed BS. No, it was a game changer. It was the most cogent, comprehensive, alert, and engaged I've heard Janet Yellen in quite some time. And she finally, after making her, the brutal mistakes, corrected some of the tough talk about rate hikes. So that's why you got your rally in stocks. So, however, here's the however. We've rallied a lot already. The market came off of 181 in terms of SPY, and we basically peaked out. I had discussed a level with you guys for a while that I thought we were going to see. I said 206.76 was going to be the level to start booking profits into. Yes, we did trade through it. We often do some. I mean, you can. It's kind of hard to stop on a dime sometimes in the markets. I'll tell you, my levels that I give you guys often do stop on a dime. It's sometimes a little eerie to me. Someone had mentioned today. I had posted about a bounce happening in the market, and they said it was a little eerie, and it was like to the tick. So yes, it can be a little bit eerie sometimes, but it's also possible to have a little bit of an overshoot or an undercut. So that level to me was important, and that's really, why was that important? It's the big bulk of a volume profile distribution. It's really where the meat of a distribution came into play. That door to that distribution, you can argue, is anywhere between 204.12, which is where I say it is, or 205-ish. Really like 20. Yeah, let's just call it 205. You would also add a 78.6 up there around the 205s, and this is just a area where there had been a lot of chop and there's a lot of responsive selling. Anyone who bought up here before the kind of meltdown is happy to get their money back. And the fact that we have a little bit of sideways chop and some responsive selling is very normal in the market. The couple of caveats to that, and this is what disturbed me a little bit, was when you look at SPY, you basically, if you follow along on the charts on 329, that was the Yellen day, and the key level there was the 205.23. That was sort of the breakout of the range. So you spent 2 days above there with the gap, and I had said it wouldn't surprise me to retest the 204.12-ish area. We did. We undershot a little to undercut a little to 203.98, but then rallied strong, and you had this big engulfing pattern. And the next day, which I think a lot of people took as bearish, but really was just consolidation, was an inside day, and we were kind of just struggling. We had 2 look above the 206.76 and fail. But the following day, which was Tuesday, was a pretty nasty gap down that took out the low of that pullback low, and you re-challenged those 204 levels. That really should not have happened, in my view. You had now a hold of the 204 and a solid rejection, and now you were back down there. I think it caught a lot of people by surprise, and you had a lot of people get kind of liquidated that day. What was a little odd then was that yesterday was a re-challenge again in that area of the 204 and a rejection and a close above the prior day's high for the gap fill. And that really should have been it, so to speak. The bulls should have really taken that and run today. It wouldn't have even surprised me to see some type of a gap up, given the fact that overnight inventory was, or I shouldn't say a gap up, but yeah, I mean, we could have seen a gap up, or we should have seen some more responsive buying today, because overnight inventory was I wouldn't say it was 100% net short, but it was like 95% or so. There was a lot of people who were short, and there should have been an inventory rebalance, and you didn't really have that today. You didn't even have very strong breadth today either. It was like, for most of the day, it was like 1 and 2 and 3 to 1 negative. Toward the end, when things started to get a little iffy, it was getting up to that. It was challenging the 5 to 1 negative. One of the reasons why, and some people were asking why I was saying, I got a couple of messages why I was saying I thought we'd see some bounces, where we did, and why I posted it at the time we did. This is a little bit of a I guess a trade school sidetrack. I saw a few things. One, we had moved a lot already. We were, the overnight high had been 2062. Usually we don't top in overnight or pre-market sessions. That's why I thought today was more of a bit of a liquidation break, and it just got a little bit out of, I wouldn't say out of control, but a little bit more carried away than maybe we've had. I was seeing a few things. One, we were at an S2. I don't usually love S2s that much. I'm more of an S3 kind of guy. But we were at an S2 after a huge move down. We had a VPOC, a couple of VPOCs, which is just virgin points of control, which were untouched. One right below at 2025 and one at 2017, I believe, if I recall. So I thought somewhere between that S2 and the 2017 would catch a bid, and we wound up getting some news. Some of the bearish news today was reversed of the Treasury Department. We know they've killed now the Pfizer deal. It looks like they're going to kill the Baker Hughes and Halliburton deal. And it sounded like they were looking to kill more deals, and then they kind of clarified and said that they want Congress to act. So we don't have as much of an activist Treasury and administration as maybe we thought. Yeah, a lot of the premium, I would say some multiple points are deal scenarios. And I'll tell you what companies are going to do M&A if they think that they're going to get killed for it, if they're going to be in court and penalized for it. The answer is they're not. So that, I think, today was a lot. I would say the last, that Allergan blow-up deal, and then I think today was a little bit of an extension of that, kind of that hangover. So you had that with the Lagarde comments weighing on it. And toward the end, I guess that news, I don't know. It's funny, the news always falls along the line of least resistance, and it always, for some reason, I'll tell you this, always seems to somehow magically coordinate with the technicals. They always seem to add up, and that news broke right as I posted my basically right as I was posting my tweet. So it worked out. It actually worked out quite well. So I would have liked to have seen a little bit more excess today. Believe it or not, we had some poor lows. I just want to look quickly at something. Yeah, the lows were a little bit poor today, and usually if you we got some news on that. So you had a lot of people pressing late. They didn't get the end of the auction, and then they kind of often when you have a poor high, you get the back off and then the repair. With a poor low, often you get the back off up and then the repair lower. So it wouldn't surprise me to see a little bit lower, even given where we closed in SPY. You know, this is sort of a game of inches here. I had said we really needed to close 204 or above. We closed 203.95. It's below the 204. I hate to say that. You know, it needs to confirm. Could we be up tomorrow? Yeah, absolutely. We could be up. It could just be a look below and fail. But you have to be a little bit more cautious. I take it from level to level. For me, the first level of caution was anything below the 205.23, which was the breakout. And I said in SPY, in ES. Anything, I started off saying anything below 20.52 quarter, and then anything below 20.41 half would have me very, kind of suspicious. Today we basically gapped down into value, broke down out of value, and then we tried to rally back up, couldn't. And then once you saw that failure, I think it even failed just below value. Yeah, it failed a half a point below value area low. I had said today 20.43 half to 20.41 half, anything below there to me would get iffy. And once it was clear the bulls couldn't hold there, that's when you really got your real selling kind of later into the day. A lot of the price action today to me, there were some people posting, oh, are we going to get a flash crash? And I just wasn't seeing that today. It just wasn't. Today really to me wasn't that kind of day. This to me was just a lot of people who bought yesterday, who got disappointed, and then they sold it today. And that's the kind of the same thing that happened on Tuesday. A lot of people sold and got short, and then they got taken to the cleaners. I've noticed this week, the whole week, just the way. I mean, I just have that. I'll tell you, I've been trading for a long time. I have a lot of experience watching price action, and I could kind of tell the character of how things trade. This has been a lot of algorithmic trading. I know there are a lot of people who are, anti the algo. They think it's a conspiracy theory. Algorithms are real. They exist. There are whole companies dedicated to hunting your buy and sell stops and hunting high and low volume nodes in the market and shaking people's, ringing their bells. And I'll tell you, just the way I've seen some stocks trade through certain levels and then reverse. This is purely what's going on here. This to me doesn't look like big time liquidation. If you were seeing big time liquidation in the market, you wouldn't have stopped today. It would have been, I guess you had a lot of characteristics of a trending day, but you didn't have the bad enough breadth. 5 to 1 is sort of like the vestibule for trending days. For me, it's really got to be 8 to 1. If we were sitting 8 to 1 and we were seeing that breakdown toward the close, I would have been all on board for some type of a flush into the close. But we were struggling to hold 5 to 1 even as the market was breaking to new lows. The breadth overall reading was starting to improve a bit. So that to me was telling me that it just didn't feel like that kind of day. Today just felt really soggy to me. A lot of disappointed people, a lot of profit taking. When I talk about levels being a little bit eerie or when you get to certain spots, look where we were in some names. Like let's just take Apple, for example. I mentioned that the other day. I've been pretty good on Apple, actually. I had talked about a couple of weeks ago saying that I was the most bullish in Apple I had been for a while, and that I thought we could have a rally. We did. We got basically where I thought we would get. We got to the downtrend. We had a mini look above and fail at the 200 MA, and the back off has been a little bit mild. Today was a little bit more than the last few days. We did close below the 109.14. 109s. I'm willing to even stipulate, and I said this on the Twitter today. As long as we hold like the 107s or 109s, I think that the Apple pullback is kind of quote unquote acceptable. If we start losing that bracket, it's gonna get a little iffy, and I'm gonna start thinking 103 again. Apple loves to fill some gaps. I'll tell you, we have earnings coming up. The best scenario, and I know no one wants to hear this because they're probably all longed up Apple now, would be my favorite setup, the shake and bake. We shake everyone out with a move down, and then it gets a rally back up. I think that the problem for Apple is that the quarter might not be spectacular here. It might give an opportunity. I would say that if they have a junky quarter, and it sells off, Ricky Bobby. That's right. That's where I get. That's actually, everyone always asks me where I get the shake and bake from. It's actually an homage to Talladega Nights, the Ballad of Ricky Bobby. That's right. That's where it originally comes from, and of course, I'm a big movie buff, and I applied it to the stock market. I have a lot of other sayings I use, but the shake and bake is from Talladega Nights. That's correct. Good catching that. So that would be the ideal shake. The shake and bake to me would be a great setup if we could see that happen in Apple. Someone just met. Yeah, this is historically a weak quarter for Apple. They don't really have any new product launches. They didn't launch much to my dismay, I'm so upset, they didn't launch the new Apple Watch. I mean, I've been waiting for the second generation Apple Watch. I'll tell you, my grandfather taught me a couple of things. One of the most important things is he always said never buy the first model of a new car. And I kind of apply that to all technology. You wait for the second generation once they work out the kinks. So I know myself, a lot of people I know, even some of the Apple Store employees I speak to are waiting for the second gen watch. I wish they would launch it already. They lowered the price. It might get tempting enough. I don't know. I'm just sort of trying to wait for the second gen. So that's the story with Apple. Let's see. I'm just looking for the list. I mentioned, so here was another one of the woes for today. And I don't know if this did get picked up. I heard the TV guys talking about it, some of them who follow me, I heard talking about it, some of them I follow, some of them who follow me. I am a little concerned, and this to me could get very serious. The European banks, we had a bit of much like China, we had a bit of a reprieve the last few weeks, and then I would say the last week or two. Let me see, how many trading? Yeah, we've been slowly coming down. And we're basically almost at the lows again in Deutsche Bank, and Credit Suisse, and there were some other ones. I can't think of them offhand. These are really the two I watch. That's not good. That tells me that there could be something lurking if we lose those lows. So the best thing these banks could do here is have some type. Oh, someone asked what's going on with the bank. I will discuss the fins right after this. So it's not good that these banks are going lower. It makes people think, rightly or wrongly, that there is systemic risk out there. Oil has been pulling back a little bit. There's something going on, I believe, in these European banks. Maybe they have some kind of write-downs they need to take. Capital raises might have to happen. They basically all got back to breakdown points, and now they're sinking again. It's very possible there's a double bottom here. Don't get too crazy just yet. They do need, a lot of people like to anticipate the lows being taken out. Sometimes they're right, sometimes they're wrong. For me, I kind of wait and see for it. I actually wait for it to happen, believe it or not. I try not to anticipate. I try to actually go by the levels. Yeah, I mean, you can tell sometimes how something's trading that you're pretty sure it's going to go. But, let's give it a chance. Let's see what happens here. So that is a major problem. That could be a black swan into the summer. We have Grexit and Brexit and, I don't know, all kinds of brunchy sounding names coming up. So, we also have earnings coming up. There's probably, for sure, a issue with regard to buybacks, companies not being able to do buybacks. You have a bit of a vacuum in information, and we're subject to these macro events. One of the things that could be weighing as well on the overall financial sector is that we know they've been regulated. They're basically utilities. Their outlooks for making profits are very dim at this point. They can't do the speculative hedge fund type of things really that they used to do pre-Dodd-Frank and all that Sarbox and all that stuff. They are very dependent on the Fed raising interest rates. Remember when the banks were all rallying was when everyone thought the Fed was going to raise rates, and now that Yellen came out and said no rates, A lot of these stocks are trading super cheap. Some of them sub book value. I think it's just because that their outlooks for potential profits in the future aren't what they once were. They're sort of, remember years ago, that's not your father's Oldsmobile or your grandfather's Oldsmobile. This aren't really your father and grandfather's bank stocks anymore. They have decent dividends, and I don't think that they have the type of systemic risk that they did, in 2009, although there could be some fears of counterparty risk, particularly with the European banks. But they are definitely in a better situation than they were back then, and I just don't see that as being a problem. That doesn't mean that they, just because they're not going to crash doesn't mean that they're going to go up, though. That's a bit of a problem. You have, they're playing. They're also now here talking about this, as if zero interest rates weren't a bit of an issue enough. They're also starting to talk about the possibility of doing what they're doing in Asia and Europe with these negative interest rates. So maybe that's also what's weighing on some of these bank stocks as well. The fear that we might move to that model as well, and I'm sure that's also, by the way, hammering these European banks. The big if to me, though, with Deutsche Bank in particular, is that a lot of the business that was here in the U.S., the speculative business of all the fancy and exotic derivatives, has gone to them, and they took on a really big derivative book, and sort of nobody knows what they've got going on there. It's sort of a bit of an issue for them. So that's my take on that. And I'm just trying to think, is there any other issue with regard to with that? Yeah, I mean, I think that covers that. I think that covers some of the levels that we discussed there. I'm just looking at some of the stuff you guys wanted to talk about more. I think that covered Deutsche Bank. Whoever had asked that, just write DB okay or DB not okay if you're satisfied with that answer. I'm just taking off some of these stocks. We covered the financials. All right, so let's get into some more other of these issues. The VIX. All right, so I talked about, the VIX has it's not like a stock. It could never go to zero. There's always someone looking for some protection, and I had warned that we were getting kind of close to the lower end of the range, which was really like 1280. I said it would be possible we undercut it, but it would be a buy. So it doesn't surprise me. Today we basically, again, for the second time, got to the backside of the old uptrend, and it rejected a little bit. We closed below. I wouldn't be surprised to see the VIX have a little bit more, I should say a little bit more uproom. The 1785 is an important level, and the 200 and the 50-day MA are roughly equal here in the 1875-ish area, so it wouldn't really surprise me to see a move into that area. So that's my take on the VIX. It just got a little too cheap. You have a new quarter. People are probably positioning and putting on a little bit of protection. Not a big surprise here. I haven't really seen. I mean, today, as bearish as things today. The VIX was up $2, but it's only at 16. That's not really super duper crazy. 16 to 17, if you look at my VIX chart, is fair for VIX. So we were trading below a fair level, really, and now we are trading around the fair level. Oil. Let's discuss oil. Let's not BS each other. Oil is really what drives a lot of the algorithmic trading and what drives a lot of the moves in the market. You had a contract roll, a gap. It filled that in. It spent like 9 days or so selling off, and now it's stabilizing. We had a couple of days of rally, and then today was a bit of a shake and bake below 37. As long as it's above 37, I think that it can go higher. If it gets below 37, then 33s come into play, 32s, 33s. 50% fib of the entire move would take you around the 34s, which was really the breakout. The 50 MA is in the 34s, just below 35. So there could be a little bit more consolidation in oil. I believe that oil is kind of seeing the worst of it and that it's probably going to see higher at some point. The one fly in the ointment there, and one thing that has me a little bit cautious, is Exxon. I've I discussed Exxon 83 in this video, in my weekend review video. Go back and look at that. It's very important. Yesterday, we only really started to rally hard once Exxon got over 83. Today, Exxon was just not good. It didn't close above 83, so that has me a little concerned about the overall market and about oil. If you can get back up over 83, it's really that simple. Exxon 83 is sort of the key. XLE, on the other hand, a lot more kind of relative strength. It got the downtrend line. It's backed off, considerably, but it's really been kind of holding. It's been kind of holding. I like that. That's good. The 50 MA is catching up. It's still holding the 100 MA. That's good. I mean, that's good. I really don't think you start seeing a lot of problems in the sector, meaning pukage, until you get below the 58.74-ish area. If you start breaking the trend, then we have got problems, my friends. You can really start to see a filling up of the triangle, and believe it or not, that could have some legs, maybe more than people would like to see. But as far as I'm concerned right now, XLE is kind of holding its own. It had a double bottom around 60-40-ish. So I think between 60-40 and like the 58s, that should hold if it's still going to be healthy. If that starts really breaking, it's going to get iffy, and that's going to weigh quite heavily on the tape. All right, so I'm just checking through one by one what you guys wanted to talk about in the order in which I wrote it down. Amazon, not seasonally the best time for Amazon, but it's been holding in kind of well, just consolidating. I'm going to keep it really, really simple with you guys. As long as Amazon is above 585-ish, you can play long. If it start getting below there, then you're probably going to see a 50 MA test. Just keep it that simple. If it holds the breakout, it's okay. Below there, to me, gets a little iffy. Yesterday's price action was, I thought, pretty bullish. Today negated a lot of it. You didn't happen to take out the lows, so it still has a lot of relative strength to the overall market there. So let's just keep it like that. 585 is the line in the sand. The Facebook. I keep getting DMs and emails and calls and even groupies waiting in my lobby for me to sign Facebook autographs. I'm half joking there. Everyone wants to know, when is Facebook going to pull back so that they can get the opportunity to... Oh, my gosh. We have something amazing that just happened. You know how I always talk about the progression line in Facebook? I happen to have been having an issue with that. It was showing that the progression line, I told people that it was showing in the 116s on one chart, and it was just showing in the 118s on another chart. I happen to just be able to catch it showing the 116s as the progression line. I'm going to tweet that out now. So take a look at that chart. You'll be able to see what I was talking about. This is where it stalled out. It got the progression line. Any moves on the other side, the wrong side of that progression line, become unsustainable. The back off, however, has been relatively mild given the overall strength of the stock versus the market. I will maintain this much. The 110.65, as long as Facebook is above 110.65, it's going to probably go higher. If you get below there, I've speculated that you could see the 50 MA is very important in Facebook. It's quickly rising, believe it or not. It's 108.79. So I don't know how much downside you're going to have in Facebook. I would love to see a shake and bake in this one before earnings. It would be just great. I would love that. However, Facebook usually tends to run on earnings. It usually runs with or on Google, or Google runs on Facebook, and then it kind of does the move. I have a little bit of Facebook on. I had talked about taking it off in the 116s both times actually, so I kind of nailed those tops pretty well. It's not behaving like a stock that really wants to get creamed. It is overbought technically or stochastically. I would be a little bit cautious with it. I like buying the dips a little. I will tell you this though, the better way if you want to play Facebook is just to wait a little bit until the earnings. I assure you the earnings month IV in that series will go up. You'll be able to sell puts more expensively closer to earnings than you would now. If you must do it, do a little bit now and then do a little bit later. That would be my best way to play Facebook. You could take that you could take that however you want, with a grain of salt if you want, or you could do it that way. I can just talk about how I see the chart, how I play the stock. That is the the trick. Buy the dips and sell the rips into the resistance. So I'm going to maintain that I think it's still a long as long as it holds the 110.65 and the 50-day moving average. Anything below there, I can reevaluate a little bit. IWM. This has been a really big kind of red herring for a lot of traders, I believe. I will say this. It really should have gotten the gap fill to the 112.62, which is also the downtrend line. It stopped on the 50% fib. It couldn't get that gap fill. It couldn't get the downtrend line. It couldn't get the 200 MA. That weakness speaks to me a little bit. It doesn't mean that we could reverse and get it tomorrow, believe it or not, with this crazy tape. But I haven't really been playing that much with regard to IWM. I'm just not a huge IWM fan. I have played it with some success in the past, although I am not really playing it at all at this point. I just think it's a lot of push and pull, and I prefer the SPY. Sort of grown in sexy in SPY. Try to not crack up sometimes. Gap, someone asked about Gap. I'll tell you, I'm a fan of the Banana Republic clothing. I think this is H&M, believe it or not. It's not Banana, but I have a lot of Banana clothing. They have trained their customers now to wait for the sales. This happened during this really started during the financial crisis when everything wasn't doing well. And I think people now are just trained, and I think that their margins are compressing, and I think that they are suffering from being in a store-based model. That is just my opinion. It looks like it ran into some problems around the 200-day moving average. It's pulling back. If you want to play a right or right out trade in the gap, let's see. It basically had to look below the 61.8 and fail. And then it came back up. That's a price level. I was just going to throw a Fibonacci on this range here to kind of give you guys an idea of what I was thinking with this. Gap, honestly, to me, is just not like that great of a retailer. You could try the 50 MA. I would be more apt to try around like 25-ish. The 25.99-ish is the 50 MA, and then I should make sure that this locked properly. I'm giving levels, and I'm not even sure if this is the exact numbers that would be troubling, and they're not. Hold on. Let me just adjust this. Check that level. Put in the right level. Sorry, this will just take a sec. I'd rather give you guys the exact right numbers so that there's no ambiguity. Yeah, I was right, basically. 26 is the 50%. I'd be into trying the 25-ish level, 24.98. That's the 61.8. There's a lot of, that to me, to my eye, looks like that would be the place to do. If you want to try put ratios for a move down there, give it a whirl. But row. Tesla. So seasonally, this is a great time for Tesla. They tend to peak out around the horse show. I don't know how many of you are Hampton Classics fans, Hamptonites. I'm not sure the exact date. I'm going to Google it right now. Hampton Classic. I'm trying to look for the dates. I might have to do this in the weekend review. I know it sounds crazy, but that's usually when this sucker taps out. I'll put that in the weekend review. If I forget, someone just remind me. But that's usually when this kind of... someone just posted. August 28th through September 4th. That's usually when Tesla likes to top out. That's the dates. I will reconfirm that, though, for the weekend video. We did, however, get to a very key level that I've been talking about, which was 265. That had been an old top. It ran through there. I think it got into the old. I mean, it ran through there once for the old all-time high. Actually, it's run through there before. The old all-time high was 286s. Was it? I thought it actually. No, the old. Sorry, 291.42. And then it's. I mean, basically the point is this: is that any moves above 265 in the past have been unsustainable. It had run a whopping huge amount from 141 up to the 265s, basically at a breakneck speed. You get up to that kind of resistance that far, that fast, you got to book some profits. I talked about selling at 265 or north. If you did that, congratulations, you did a great job. I would be waiting here for a little bit of a pullback. I don't know how much of a pullback you're going to get. I actually wouldn't be surprised to see this thing do all-time highs. There's a reason why Tesla's up this much. And I'll tell you, a lot of shorts, I think, get very frustrated because they don't really understand the story that is Tesla. They keep thinking that it's a story about valuation and that the product, that's really not what Tesla is about. What Tesla is about is this. It's about a high short interest stock with like 33% short interest, high consolidated inside ownership. I think Elon Musk and his family, I think Elon Musk owns like 22% of the stock, plus 33% of it is short. Yeah, that's a lot. It's like half the stock there is, either held with strong hands or short. Poorly distributed, meaning it's not owned by a lot of funds, and when you add that up, you get a recipe for a short squeeze. Elon Musk is probably the squeezer in chief. The guy has the efficiency of a hydraulic press, and he is great at creating these situations. I know that there's a lot of talk that they're going to have to do some type of secondary. Yes, I'm sure that will happen. It would behoove him to do it while the stock is high, in my view, but I will tell you this. I don't know how much of a pullback you're going to get on that, because yes, it will pull back, but it might not be as much as you think. And the reason is this, is that Elon Musk, they tend to do smaller capital raises than people anticipate, and he buys in on it. A guy buys like a chunk of it. And I don't really see him selling that anytime soon. So Tesla, to me, clearly here it's overbought. I talked about booking the profits here. Good idea. Yeah, you'll probably get a pullback to the low, a little bit lower into the range. But like I said, it would not surprise me to see this thing, get the move to, finally get to the 300 mark, maybe even, go higher. But this is definitely a name you want. It's just the deep end of the pool. You want to buy it on pullbacks, not to chase. Microsoft, someone asked about Microsoft. 55 has just been like kryptonite. It's been struggling. It's just chopping. I mean, the stock to me still looks pretty bullish. This is they make a lot of money, Microsoft. I'm sort of not such a big bull on Microsoft. I mean, they have a dividend. It's getting a little small now because the stock has risen so much. My concern with Microsoft was always that Google was basically giving away their stuff for free, the Google Docs, and it was starting to compete, and more people are using Apple. They're using less Microsoft. Honestly, I almost never use Windows machines or products anymore at this point. I just think that they're crappy and poorly built. Definitely more of an Apple fan, but it's a cash generator, and they're moving more into the cloud, so I guess they're doing well. Yeah, it's got to get through 55s. If it can solidly clear this resistance, the stock can go higher. I would say it's a buy the dip name, but it's been a bit of a tough chase if you have been trying to play it that way. Anyhow, I think we covered a lot of good stuff here. I'll cover a little bit more of some of this stuff in detail. It's always a challenge for me to do this on Periscope, just because I can't show you guys the charts. I really have. If someone has some better ideas about like a hybrid maybe where I can do interactive charts, someone had messaged me something the other day about that. If you could just send that to me one more time, that would be great. Maybe even email it to me. That would be even more helpful. But that would be great. Anyhow, that's my story. I'm sticking to it here. Let's keep an eye on the situation for tomorrow with regard to SPY. We want to know The key here is if it can sustain below the 204. The key level, really, the real true key level is 203.98 to 204.12. Anything below that band is iffy. If it can get back up above there, if it could get back up now above the 205.23 and today's high, then I think we're seeing 209s pretty fast. If it stays below, act accordingly. It's probably going to see the 201.90. Let's keep it simple, stupid. If you missed this, or if you want to watch it again, or need some whatever, it's going to be on my YouTube channel shortly. That's Justin Pulitzer Trades. Be sure to subscribe to that. You'll get notifications when I post these videos, the Periscope rebroadcast, weekend review videos, or special edition videos, which I need to start doing more of. Love those videos. Anyway, let's have a good rest of our week, and cheers.